All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. And it's my favorite co-host, Tim Vest. He brought up a great show topic this week. We've been, he had to remind me this morning that we have been talking a lot about this kind of business model and why buy and hold makes so much sense compared to flipping, right? Significant value add deals and flipping. And we've had a lot of conversations. I have had two conversations this week, and it's only Tuesday, on how people's business models are changing and how the real estate landscape is changing. This is feedback directly from brokers, and we're going to dive into a little bit because I want to be transparent, tell you guys what we're experiencing and some of the feedback we're getting from the market and other real estate professionals in the industry, and hopefully you take away something with this and maybe reevaluate or change your perspective, and if you don't, that's okay, right? It's just being aware of other options is always a good thing. So Tim, how you doing today, man?
Good, not bad. How about yourself?
Can't complain.
Yeah. Yeah.
There it is.
Touche.
Yeah. All right. So I have had, hey, good morning, Dennis. Happy belated birthday. I saw it was your birthday this morning on my past Facebook thing. So sorry to write on your Facebook wall about it, but I'm calling you out now. There we go. Put the comments up there. Good. All right. So why buy and hold makes so much sense. Tim and I, last week we were together and we went out to dinner and we were talking about how the business model is ultimately changing. And the core principle about why the business model is changing is because the real estate landscape has changed, right? Investors' needs and investors' wants have changed. And if we're going to continue to syndicate deals and provide returns for our investors, we need to be able to pivot and change our business model relative to what investors want and what type of deals we have access to. Fair or unfair?
No, I think it's fair, for sure.
If we want to continue to do deals and grow our business, because remember, at the end of the day, we are a business that provides investment opportunities for real estate investors. We invest ourselves, we own ourselves, and we provide those options to people, right? Ultimately. And that's the core of our business at the end of the day. And what we've heard over the last 12 to 18 months is that I'm not getting any cash flow. And well, a lot of deals in the last 4 to 5 years, there was no cash flow. It strictly was value add appreciation plays, right? Where the market was hot and you could buy something, you could do a little bit of work and you can flip out of it as a value add deal and move on to the next deal, right? I mean, essentially, flipping apartment complexes, much like a single family person would fix and flip a single family house, right? I mean, it's really no different. But investors got comfortable, myself included. I'm not going to point the finger here, myself included. Investors got comfortable with large equity gains and no cash flow over the course of a short period of time. Flipping, okay?
Mm-hmm.
And the real estate market has changed. The commercial real estate market has changed. I don't really know much about single family stuff, but I know that the commercial real estate market has changed. And because the landscape has changed, transactions are not happening as easily. The values have decreased 20, 30% over the last 18 to 24 months, 12 to 24 months. And investors are like, well, we were supposed to refinance. I was supposed to get all my money back. We were supposed to, start getting cash flow distributions once we hit the refinance, or we were going to be able to sell it in 2 to 3 years. And now you're saying that we can't. And I'm like, well, yes, we can't, because property values are down. Insurance costs are up. Property tax costs are up. Utility usage costs are up. Payroll up. Everything's up. And you know what's down? Fair market rents. Fair market rents for 2026 got posted. I know I specifically looked at it in Charlotte, North Carolina, and the fair market rents have gone down 6.5% for 2026, right? That tells me that if in order to hit a refinance on a property that you bought in the last 24 months, you need to execute on your value add business plan in order to make it to a refinance. A lot of people that are not hitting those refinance numbers, it's because they're not doing their value add successfully. They have not
Yeah.
managed expenses. They have not increased the income. They have not renovated their properties. And they're unable to take out their first position debt and cash flow the property.
Yeah.
Now, unfortunately or fortunately for us, we are able to take out our first position debt because we executed on the business plan. However, the real estate market has changed and we're not able to refinance we're not able to refinance a lot of our investor cash at this point because the property values are down, right?
Yeah.
Property values are down, cash flows down. We're being limited on LTV and debt coverage across the board. And it's been difficult to close loans right now. And a lot of investors are saying, hey, I need distributions. And well, it's like, well, when we originally did this deal, this really wasn't a distribution deal. It was,
Yeah.
hey, we're going to do our value add because the market rents are significantly undervalued. We're going to turn around and sell this. We put some conservative underwriting in there that we decompressed the cap rate. We increased, expenses across the board, and et cetera and so forth. But some of the changes were unforeseen, and we're feeling the effects of it now, right? So what does that mean? And how are we going to change in order to continue to grow our business? We talked a lot about this last week during our 2026 planning sessions. And ultimately what we need to do, and the feedback that we're getting from other brokers in the market, is that the next 2 to 3 years, there's going to be a lot of transactional deals of people who are distressed sellers that just need to dump the property for the cost of the debt, right? If you assume that some people bought it at 25 or 30% down, so 70 to 75% leverage, and you're buying it for the cost of the debt, you've immediately just got a 25 to 30% discount on the property, right? There's going to be a lot of that. People are going to be able to scoop up some properties for cash, for quick, turn around, sell it in a year or two because they bought it at a great basis because the other guys were distressed and couldn't take out their debt, and it ultimately kind of reset the comps, right? That's kind of what's happening right now is we're resetting the comps of commercial real estate property values. And the next 2 to 3 years, you're going to see some transactions start to pick up. There's going to be people selling in distress, people buying the distressed properties, and then turn around and flipping it quickly. After this initial 2 to 3 year period, which probably will come to an end sometime in 28, 29, 30, you're going to see a lot of people buying traditional real estate assets the way that it was done before, right? And a lot of people, myself included, have only seen what we just went through, right? Where the debt was incredibly cheap, deals were flying off the shelves, investor cash was really easy to raise because the economy was doing really well. People, they're going to be analyzing deals differently. They're going to be analyzing it on your in-place cash flow. They're going to be analyzing it with a 5 to 7 or 10-year agency loan. It's going to have to be 90% occupied and 90% collected over 90 days. And there's going to be a lot of contingencies put in contracts now that sellers maintain those occupancy and collection levels. And this high transaction volume of being able to refinance quickly and get all your money out and sit on a deal while you ride the appreciation wave is I think is really going to be gone. I mean, do you think I'm completely off my rocker here, or anything you want to throw a wrench in there?
No, I don't think you're off your rocker. And honestly, I mean, you brought it up and we're just kind of skipping over it here, but I think one of the things people miss, and you're talking about predictability and things like that. I think one of the things people miss with real estate is when you flip, like I love, believe me, I've flipped. I love those quick paydays. I love seeing, my bank account go up substantially overnight. But when you flip, you pull out equity and you introduce it back into a checking account, a money market account, whatever. You take it out and it is now at risk of inflation, right? So essentially,
Well,
think
that's a
about this.
good way to say that. At
Well,
risk of inflation. I've never
think
heard
about
anyone
this.
say it that way.
You sell a deal, you sold a deal last January, for example, or January 2024. And we've all talked about, like, it's been a struggle to find deals that pencil right now. So there's a good chance that there's a lot of you sitting out there with liquidity in the bank. Well, guess what? That liquidity has lost value over the last 18 to 24 months, right? Whereas had you locked it in, and let's talk about folks who would have locked in early 2023 or whenever the rates were like 4.5%, they would be locked in at the same at the same loan basis at paying 4.5% with cheaper money now, right? Because their money since 2023, any liquidity they have, any money that they're making today is worth less on a dollar basis than it was 2 years ago. So you're paying back your loan with cheaper money on very low interest, probably a point and a half at least lower than what you could get today. And I think that's what people miss sometimes about real estate, especially when we're like, hey, I want to take this quick buck, right? Is you pull it out and you take that money. And if you don't have anywhere to deploy it, you're at risk of losing value on the money you have sitting in your pocket. Whereas real estate actually protects against that, especially if you're locked in for long-term debt. I mean, quite frankly, guys, like I'm sitting in this house and, I'm locked in at 2.85%. And and it's a house I've been in for 19 years, guys. Like my loan payment is so incredibly low, right? And I'm locked in at 2.5%, and I'm paying back with money that's been devalued over the last 5 years. So, I mean, as far as cost of living goes, like my cost of living is pretty damn good on this house, right? Yeah. So
I wish I had me some of that debt.
me too.
Oh.
Me too. Because believe me, where I'm moving next year, it ain't got this kind of debt on it.
Right.
By the way, Congress, portable mortgages, make it real.
Portable mortgages. Yeah, right. No shit, man. Oh, that would be nice. I think that's an interesting play. But
we're like one of the few countries that don't do it.
What's that?
We're one of the few like main countries in the world that don't do that.
Oh, really? I had no idea. I didn't know that they were portable in other countries.
Oh yeah. Oh yeah.
Oh, that's interesting. I had no idea.
Like 15 loans. Other countries have them.
No, I didn't know that. Well, today I learned something new.
Yeah.
But that's so ultimately why buy and hold makes sense is 50-year mortgages, Aaron Page. Just
I'm not a proponent of it. I just saying.
We didn't really talk a lot about it because it was kind of a dead horse, but it's interesting to see how people have done the math on 40 and 50-year mortgages, and it really does not make sense because your interest rate is so high, right? For the risk of the time period the money is deployed, it negates the additional amortization time. So yeah, sure, you might save a little bit of interest, in your monthly payment, but your total interest is going to be astronomically higher, right? Because if you think about a 15-year mortgage, you're going to get maybe, 5.5% rate. I don't know what the rates are today, but call it 5.5. And if you do a traditional 30-year mortgage, you're going to be paying 6.25 to 6.5. So if you, apply the same logic, you'll be paying 6.75 to 7% interest on a 40 or 50-year mortgage, right? So your interest rate just continues to go up, which negates the amortization. That'll only work. I agree. Yeah, people are going to be so underwater in markets that decline. You're going to have people that are locked into their properties that can't move because they don't have the money to do it.
Right.
So transactional volume goes down.
And guys, so remember, and again, I don't want to make this a 50-year mortgage conversation, but remember, it's a tool, right? It's a tool that only should be deployed in certain areas, just like 3-to-1 arms. I don't have a need for one right now, but there's a world there are scenarios where 3-to-1 arms make sense. And just like we're talking about, like a 15-year mortgage makes sense for somebody, it doesn't make sense for me, right? That kind of thing. So just remember, it's a tool. Doesn't mean we shouldn't have it. Just means you need to understand how to use it.
Mm-hmm. Yeah. So back to our, why buy and hold makes sense and how we're going to end up pivoting our business model some. The underwriting and the analysis is going to look way different. And I literally had a conversation with a broker yesterday who's probably watching this show. And he was like, you are seriously the second or third group in a week to tell me the exact same methodology of how you're going to be underwriting deals and making offers going forward. And he was like, it is going to be so hard to sell a value add deal going into the next 5-year phase because everyone's going to be looking at everything on an in-place cash flow basis, right? Now, as a seller and a buyer, you have to consider, when we underwrite deals, we're always looking at in-place cash flow, right? Buyers can be optimistic in order to make a deal work over a longer period of time by adding in cash or by adding in appreciation and adding in, rent bumps and maybe expense management and stuff like that to add value to the property. But a lot of those conversations and that argument is going to go away because everyone's going to be like, well, your property's only making $100,000 a year, and I'm just going to assume that it's going to always make $100,000 a year, or at least the conversation will be, I need to make 7% of my money on the $100,000 that's already there, right? Does that make that? I probably didn't say that very clearly. But people are going to say, hey, I can't deploy funds if I'm not getting 7% cash flow day one, right? It's all going to be based on in-place cash flow, and NOI is going to be adjusted for tax and insurance costs, right? And in-place debt, right? People are going to be buying with agency loans, and we're getting agency loans in the low fives right now. So agency debt, is really the smart play right now. Could rates go lower? Yeah. Could rates go up? Definitely. I think locking into a 5 or even a 10-year 5.25% interest rate loan right now is not a stupid move. The closer I don't know, in my opinion, the closer we get to 5%, the more it makes me want to lock longer term debt, right? Just to kind of ride out those fluctuations. Because,
100%.
If you look at the economy, when's the Fed supposed to meet again? Today?
I don't know.
The Fed's supposed to meet sometime soon. And, everyone's talking about rate cuts, right? But why does the country cut rate? It's to help the economy. And the jobs market is suffering significantly. So they're cutting rate in order to bring back more jobs to the economy. And that is going to bring back inflation. As a real estate investor, especially commercial real estate investor, inflation is a good thing, right, for you? Because if your rents start going up 5, 8, 10% per year because inflation is 20%, I know that those are astronomical numbers, but not unreasonable. Your property value starts to skyrocket. And to Tim Best's point earlier, is you borrowed money at 5% 5 years ago, right? So that money is worth significantly less today, and you're making significantly more cash flow over a longer period of time. And I think for all you syndicators out there that are watching this right now, the hardest conversations that you're going to have are retraining your investors on what to expect by investing into a long-term syndication deal. Gone are the days of those 18 and 20% IRRs. You're underwriting to sub 15% IRR and stable, consistent cash flow without significant rent bumps and value add and CapEx and vacancy. That's going to be the model, right? That's going to be how you present your deal. That's how you're going to raise capital. And then you got to actually deliver on that. And I think, speaking from the operator perspective now, because Tim and I operate all of our own deals on the management side, it is significantly easier to manage a stabilized asset than it is a value add asset, because you just do 2-3% rent bumps. If you got a good paying resident in there that's coming up for a renewal, your goal is to get them to not leave, right? Because you got a 10-year vision instead of a 2-year vision, right? You don't have expiring bridge debt. When you have these short-term loans that you have to deploy capital and you have to get those $300, $400, $500 rent bumps that you underwrote to in order to hit your refinance, it's stressful because you're dealing with new applications, new residents, move outs, evictions, construction crews, material deliveries, delivery delays, miscommunication between the crews, dealing with draws, like construction draws. There's so much that happens on both sides of the house when you are vertically integrated like we are. On the equity side of the company, you're dealing with the construction draws, the insurance negotiations, property taxes, working on abatements potentially, or ATI exemptions, or just appealing the taxes as a whole. You're dealing with investors, you're dealing with raising capital, you're dealing with refinances. There's a ton of stuff, right? Then on the operations, the day-to-day side, you're dealing with the tenants, the turnover, the maintenance, the work orders, the CapEx deployments, the scheduling inspectors and inspections and being on site, and employee and tenant problem. There's so much, right? I think it's a little undervalued how difficult it is actually to run an equity company and a management company, to be a vertically integrated company at the same time. There's a lot that goes into it.
Yeah. And, and maybe that's a topic for another day, right? Like, I think
absolutely. Yeah, it's absolutely a topic for another day.
Well, I think that piece of it, and then the other piece of it, like, I mean, I was toying with this idea today too, is like which asset class makes sense for you, right? Because
Mm,
real estate's a broad market, guys. And there's a ton of different asset classes in there that make sense for different people.
hmm. It depends on the
Multifamily makes
return that you're expecting, right?
well, it depends on where you are in life too, right?
Y-
Um,
Well, ultimately, that comes back to the return you're expecting, right? Like if you're young like me, you're probably going to take on a lot more risk, right? Because you want to grow that balance sheet and that equity as fast as possible and as big as possible. But if you're on the other end of the spectrum, you're not really interested in those large equity gains. You're interested in that consistent cash flow so that you can live your life in those and capitalize on what you've built over the last 40 years or whatever.
well, yeah, and I think where I was going with that is like, hey, when I'm in this stage of life, maybe I'm more willing to throw 60 hours a week at something. Later in life, maybe I'm only willing to do 20 hours a week. So that's where, hey, self storage maybe makes a little more sense, right? Or
You know what? You know what deal I like the most? Our triple net
warehouse and self
deal.
storage. Yeah,
Yeah, our triple net deal that I talked to the person one time and I shot them a message of like, hey, just a reminder that we're doing a CAM adjustment and your rent goes up 4% and talk to you again next year.
yeah, yeah, exactly. I I will say that is kind of nice. Instead of every year dealing with a renewal, it's like, nope, it's in
There it
that
is.
contract you signed every year. This
Yep.
bump.
I
Yeah,
set up the schedules already, so I don't even have to remember. It just
yeah,
automatically does it. It goes
yeah.
up August 1st, 4%.
Yep. So, and here's how. I mean, shit, I didn't even know it was August 1st. I just know it's annual, and it
Yeah.
happens. Yeah. So, but yeah, I mean, I just, at the end of the day, ultimately, guys, like, I think it's kind of time to level set a little bit because I completely agree with Tim here. Like traditionally and historically, if you get close to a 5% rate, like lock that sucker in because historically we don't average in that area, right? So I mean, I tell people all the time, like the first house I ever bought, guys, like these 6.75 rates through 6.5 rates we're seeing right now, I'm like, it's really not that bad. First house I ever bought was over 8. So,
Mm.
and my parents, my mom will tell you about 17% interest rate. So I mean, guys, like 6 really isn't that bad. If you get in the fives, lock that in and ride it for as long as the lender will let you. So that's just ultimately, guys, where this goes. And then remember, at the end of the day, real estate's supposed to be a long-term hold. Um,
Mhm.
I mean, if somebody shows up and they want to pay you, you know what? If somebody shows up and they want to pay you like over market, consider it. But then I would also say, consider what are you going to do with the money when you have it? Because if you can't
That's
redeploy it back into something that protects it, then you're just going to lose.
yeah.
Uh,
That's the biggest thing is for people like you and I, we have opportunity to redeploy cash. So
right.
exiting deals makes sense, but the vast majority of investors don't have those level of opportunities available. So buying a good deal and holding it for a long period of time, kind of like buying your own primary residence, right? You're
Yeah.
probably going to do well over the long run, right?
Right.
That's the same is true with investing in stocks and real estate, and uh, that the message that I got from this broker was there hasn't been enough pain in the
Mm,
market yet for
mhm.
sellers and buyers and investors to completely readjust their
Yeah.
expectations,
Yeah.
right? That the hope for that unicorn opportunity is still strong and it's still out there and it's still there every now and then and it's like chasing the dragon for when you finally
Yeah.
get like one of those good hits. But ultimately, the vast majority of deals have restructured and have price adjusted. It's just the expectations of the buyers and sellers hasn't completely met. What they say in the stock market world is the spread between bid and ask is very large still, and that's still very true in the real estate world. And it just give it more time, and it's going to continue to come back to here's what your in place cash flow is. Here's what my debt is that I can get. Here's the leverage that I can get. I need to bring X amount of dollars to the table, and that money needs to get 7% cash flow. Here's what I can pay you. Right? It's math. I mean, it always has been math, but the macroeconomics of the commercial real estate world and industry have changed. So you're underwriting to different metrics now. Not that they were never in play before, but they just the priority has changed on what metric you're going after.
Yeah, I completely agree. And guys, like I was going through this little phase for a little while because Tim and I haven't purchased an asset, haven't purchased anything since what, October of 24.
September of 24.
So it's been a little, yeah, so it's been a little over a year, and started to be like, what's going on here? A little bit, and like, am I not looking at things the right way? Because we're pretty high transaction volume for a while there, and could still be today if we wanted to go after just anything. But I started to think about my thinking for a little bit, and then I saw another guy that I know out there that I trust a lot and I have a lot of respect for. Bill, hope you're doing well. Um, he's a high transaction guy as well, and he said that he has not purchased anything since December of 24 for exactly these reasons right here. He's like, I don't
Yeah.
need to buy anything, I don't have to buy anything, so I'm being very disciplined in what I do buy, and things just don't pencil for exactly what you're talking about. The spread is just too big between, what'd you say, bid and ask, and
Hmm.
and until that kind of corrects itself, I just, I'm very happy to just kind of sit and fine tune what I got, right?
Yeah. Tim Bratz
And
likes to talk
and do
about
some of
a
this
lot.
long term hold stuff.
Yeah. And Tim Bratz likes to talk about the
Yeah,
cost of capital a lot. Is my internet being really bad right now?
right.
Yeah.
No,
No?
you're right.
Better? Oh, Bratz likes to talk about the cost of capital and the way to kind of close that gap between bid and ask. The only way is to insert cheap debt. And the cheapest debt that you're going to get is from the seller, not from a bank. So if a seller is stuck on a high price, the way that you get your capital to the cash on cash return that you need is you leverage up with very low interest rate debt and for a very long period of time. Do you think the issue you're discussing is more localized to multifamily? I, Aaron, I don't want to
No.
say yes or no. I think it is a kind of a broad statement against all commercial real estate right now, but we specialize in multifamily, so that's all I can really speak to. Um,
Yeah,
but if the way to
I
bridge, go ahead.
Yeah, I was just gonna say, in my two cents, because I have been looking at some other stuff, I don't think it's localized to multifamily. I think it's broad against real estate. Now it's impacting different assets within real estate differently,
Mhm.
and some more extreme than others. But yeah, I mean, even down in the single family space, I mean, you're seeing transaction volume slow for a lot of reasons, but partly because of the same things that are impacting multifamily.
Yeah. Yeah. I mean, interest rates and insurance costs and
Right,
taxes. I mean, those are your three big buckets, right?
right,
Now, there's other things like utilities and payroll and other expenses that generally go up over time, but we've had the biggest price correction on taxes and insurance over the last couple of years. All those, North Carolina does it on what, every 4-year basis. Well,
mm,
the last 4 years, nothing but gains in property values. And those property tax increases haven't really hit yet. And so North Carolina is still due for another wave of pain for property tax increases based on reassessments that are going to be posted because of the increased property
yeah,
values.
yeah.
It's going to happen. When's North Carolina's due? What, next year?
No, most did it last year.
Most did it last.
Um,
Well,
mhm.
well, good thing
Most.
we tax abated most of our property taxes.
Yeah, most, but like you're talking about, like, hey, there's good and bad to being in such a fast growing area, right?
Right,
Um,
right, right.
yeah. So the good is, there's a lot of appreciation here. The bad, there's a lot of appreciation here
Yeah,
when it
yeah,
comes to
yeah.
taxes.
Yeah, but getting to those cash flow deals are going to be difficult, right? Because you have to find a way to be creative to bridge the gap to get what you need for your investors and also to transact with the seller. And that the easiest solution there is low interest rate debt.
Yeah,
I personally know of a guy, Aaron. I think you know him too. He negotiated a sale with a seller, and he negotiated a 30-year amortized loan that are principal only payments with no interest. Because the guy was like, hey, because if you think about it, he was asking, I don't know what the numbers were. It was like $1 million more than what the property is worth. Well, if you got it for $1 million less and charged interest, he would have just made his money in interest, right? Or you overpay on the value and you get no interest on the money and you locked in your profit on the sale with no interest on the money being a lender. So it's like to him, it didn't really matter where the money was parked because he was going to either pay it in interest or pay it in value. And if he had a 30-year horizon, he didn't really care about the
Yeah.
value as much because he assumed that the property value after his value add would be worth significantly more than what it is today.
Yeah, no, there's some risk on that, right? But I
Of
mean, at the
course.
end of the day, I mean, you just said it, right? Like he has the proper view on real estate, right? Long-term horizon. If he's going to hold it for 30 years, makes total sense.
Yeah, I mean, it's down the street from where he lives, like in South
Right.
Carolina. So, like,
Right.
if I had something like that in Wilmington, I totally would do it because I know I'm
For
not
sure.
leaving,
For
and
sure.
it's right down the street, and I can touch it. And if it's, I don't really want to have to drive to go see something, right? So,
Right.
like, I would do that. But
Right.
yeah, I mean, being creative, seller financing, seller carry, using those tools available to reduce your cost of capital will enable you to get into that window of expectation of your active new investors that you have to raise capital from. So,
Right.
all right, guys. Well, thanks for joining today. Appreciate it. And we will see you again next Tuesday. Peace.
See you guys.